Hi, folks.
Technical difficulties.
Welcome to the Bob Benny Wealth Management video today. I'm Bob Benny.
I'm Jesse Thompson.
And our topic today is election mania, 3 ways to deal with it. And we thank you all for attending. We're glad you're here. And if you have any questions during our presentation, we'll answer them at the end. And you can go down at the bottom of your screen and hit the question thing and ask a question, type it in, and we'll cover those when we get to the end. So thank you for attending.
So to get started, we're going to talk a little bit about why midterm election years are different for the stock market than most other years. And I have some statistics to show you guys. So here's a chart of the average return of the S&P 500 during a presidential term. So the presidential term being 4 years. As you can see, the midterm election year is actually the worst year on average for the stock market in a presidential term, which is surprising to me. I would think that would be maybe around the end of year 4 when there's a lot of uncertainty as to who's going to be elected next to be the president, things like that. But actually the stock market does worse during a midterm election year than it does any of the other years during a presidential term.
But go back to that, would you? Maybe. Thank you. But notice right after the midterm election, then the stock market usually does quite a bit better. And it's because that uncertainty is gone. So go ahead. Sorry.
Now, I also want to show a graph of the S&P 500 and what the typical average returns look like during a normal year. So the normal years that are not midterm election years are in the gray, and the midterm election years are in the blue. And as you can see, during most of the year until about mid to the end of October, on average during a midterm election years, the market doesn't do very well. In fact, the average return from November to November, starting the year before the midterm election year and then to November during the midterm election year, is almost 0% on average. So what we're experiencing right now, I guess, is what we're trying to say is that
it's normal.
It's normal. We're coupling that with other uncertainty that we're dealing with as far as the market goes, being inflation and the Fed raising interest rates that are kind of throwing a mixed bag into the uncertainty of.
Yeah. But I want to keep everybody to keep in mind, and we need to keep in mind that what's been going on this year is the news media, particularly the mainstream news media, has been fear-mongering like crazy. They started in December with fear-mongering about that the Fed was going to raise interest rates and that was going to crash the stock market. And then it was the war with Russia and Ukraine was going to crash the stock market. Fear-mongering, fear-mongering, fear-mongering. Then that inflation was going to crash the stock market. And then that recession is going to crash the stock market. All 4 of those things are big fat lies. We have evidence and proof that raising interest rates and inflation and those other things haven't historically caused the stock market to crash. But the fear of it and the harping on it by the news media causes irrational fear and has caused some people to sell, and that drives the stock market down. But the fact of the matter is these companies, by and large, are increasing their profits. And if you think about it, the value of a company is based really in real life, in real terms, on what kind of earnings they're making and their expectations of future earnings. And these earnings have been growing. And so even though the stock market is below where it was at its high at the end of the year, the company's intrinsic value, or their value relative to their earnings, is higher than, by and large, higher than it was then. And so I fully expect that once we get through the election the upcoming election in 2.5 weeks, that soon after that, the market is going to recover and hopefully, optimistically, go back to where it was and beyond.
Did you want to show the?
Yeah, I'd like to show you, I want to show you this is a 5-year chart of the S&P 500. And Jesse's going to move her pointer over to the high of the market high, which was the end of December. And the S&P 500 was around 4,800. Today, it's right around 3,600. So it's gone down about, 25%, ballpark 25%. All of it based on irrational fear, not based on that the companies aren't making money or that it should go down, but it's all based on irrational fear. Now, this happened recently in a few years ago. In 2020, we had kind of a similar situation of irrational fear. The date there of the all-time market high of the S&P 500 was February the 9th or 10th. And then we saw in a 5-week period a drop of 31%. Now remember, we're only down 25% right now because of irrational fear. But in a 5-week period in February and March, we had a 31% drop in the S&P 500. What was going on then, Jesse? COVID. That's when the news media was scaring the crap out of everybody regarding COVID. It was COVID 24/7, and it continued COVID 24/7 for quite a while after that. But when I talked to people as this was going on, some of our clients and prospects were asking me about what's going on. I said, well, there's no reason that the value of these companies should go down by 31% just because of a virus. This isn't the first virus we've ever experienced viruses have probably been around all through human history. And so I predicted that the market would go back up, and it did. And actually, I was telling people it'd go back up within 6 months or by the end of the year anyway of 2020. And I was off by a little bit. It was back up in a little over 4 months. So this is a similar type of a situation, we believe, that is irrational fear that has driven the stock market down, compounded this fall with this election uncertainty, which is obviously all going to be resolved in a couple of 2.5 weeks.
So let's talk about what investors can do, what you can do during this crazy time.
Yeah, because we promised there was going to be 3 tips. So this is our first tip.
Tip number 1, know the facts so you don't fall for the hype.
So back again to what I was talking about company earnings, because any company is based on our company here, Bob Benny Wealth Management. If somebody was to buy it, the first thing they would look at is what our earnings are, what our profits are. The car wash across the street, I talk to people about that a lot in meetings, because it's easy to look over across Old Cheney and look at that car wash. If you were going to buy that car wash, the first thing you would do is try to find out what the historical earnings of the car wash has been doing and what they're doing now, what their earnings are now. And the more money the car wash makes, the more money you're willing to pay for the company, the less money, the less. And the earnings are there. Every quarter, these companies report their earnings. These publicly held companies report their earnings. And so in January, they reported their earnings for the last quarter of December, and April, the first quarter of the year, and July, the second quarter of the year. And right now this month, they're reporting their earnings for the third quarter. And all through the year, the actual earnings reported by these companies on the S&P 500 have been exceeding what the Wall Street bean counter analysts, there's 10,000 about Wall Street analysts that analyze these companies. They've been exceeding their expectations substantially. Like at first it was 79% in the first quarter of the companies beat the expectations. The next quarter it was 78%. And right now, as of now, 69% of the companies are beating the expectations of the Wall Street analysts. I call them the bean counters, because they don't have a dog in the hunt. They're trying to predict those earnings as close as they can, and they're exceeding their expectations. and the earnings are there. That doesn't mean every company is making a ton of money and growing their earnings, but the majority of them are. And that's encouraging and should be encouraging to you that are invested in the stock market. And so if you think about the greatest financial threat to all of us, it's not the stock market going down, whether you're a stock market investor or not. The greatest financial threat to all Americans, Jesse and me and your family and your neighbors and everybody, the biggest financial threat is this hyperinflation that we're experiencing. That's the greatest financial threat to all Americans, probably all people across the world. And there's there's three bad places to have your money when there's high inflation, and three good places, general categories I've been telling people. The three bad are to have the money in the bank and checking or saving your money market, because you lose buying power with that money, CDs and bonds, because those kind of investments will not stay up or stay ahead of inflation during high inflation years. I'm talking about this 8, 10, 12, 15%. I think the inflation rate's going to go even higher than it is right now. The three best places to have money to protect yourself against high inflation are, if you think about what inflation is, it's the rising cost of goods and services, right? When I say that, everybody nods their head like Jesse just did. It's the rising cost of goods and services. So logically, what better place could there be to hedge yourself against the rising cost of goods and services than to own companies that produce the goods and services whose prices are rising? The second best hedge against inflation is income producing real estate, because with inflation, the value of the real estate goes up and your rent will go up. And then what I tell people, the third and not my favorite, is gold, because gold goes up with inflation, but it's not my favorite because it doesn't produce any rent, and it doesn't produce a good or a service that it sells for a profit. So not only is it logical that owning companies protects you against inflation and the rising price of goods and services, but we've got accurate historical proof that we want to show you too, that this is a website that we use. This isn't it.
I know.
Well, we're getting to it. A website that we use that shows us what the return of the S&P 500. Remember, the S&P 500 is a great index because it's the 500 largest stocks on the New York Stock Exchange. But we can enter in any year, a start year. Run the pointer to that, Jess. Start year. In this case, we got 1975. End year 1985. You know, most people that are my age or older remember the inflation there. I was just, getting out of high school in 1978, so I wasn't paying too much attention, but I remember gasoline just kept going up and other things kept going up. So did so did the minimum wage, all that kind of stuff. But from 1975 to 1985, the average annual return of the S&P 500, the stock market, including reinvested dividends, was 15.3% per year. And then they even adjust that on this calculator to tell you what an inflation adjusted return of that investment is, and it's 8.26% per year. So not only did you retain your buying power with stock market investments through that inflationary time period, but you grew your buying power by a little over 8.25% per year. Well, the 1975 to 1985 is a 10-year period. The highest years of inflation were what, Jesse?
1978. The highest years of consecutive inflation were 1978 through 1981.
And so we got to hit calculate there. So even then, in the very highest years of inflation, the stock market returned, including reinvested dividends, over 12%, 12.32% per year. And after adjusting for inflation, your buying power still grew by 3.37% per year. And that was better than bank accounts, better than CDs, and better than bonds. So I'm confident that the best place to have your money when we're facing this biggest financial threat of this hyperinflation that we're experiencing and going to experience for a while is in companies. And so even though the market's down right now, it's down because of irrational fear, but it's the place to have money.
And another thing is to remember is that even though it's not easy to maybe temporarily watch your accounts go down this year, watching the market go down, things like that, that it's temporary, and there's light at the end of the tunnel. And historically, that's what happens after a midterm election. Literally every midterm election since 1939, which in 1939 we were still in the Great Depression and World War II started. But every midterm election since then has been positive for the 12 months following.
Right.
And not only has it just been positive, but it's been higher than average returns. So I'm going to show you. This graph shows the maximum drawdown in midterm election years is in orange. That means that's the most during the year that the S&P 500 is what they're using here would have gone down in every midterm election year. And this goes since 1950.
It's not the whole year's return.
World War II. It's not, yeah, it's not the average return for the entire year, but it's the most that it went down at some point during the year.
Where like right now, we're down 25%.
Yes.
And that's the most it's gone down for the year.
And the average drawdown in a midterm election year is about 16%. Now in the blue bars up here, this is 12 months after an election. So it's November to November, I believe is what they're going off of an election year and following that. And the average return is 19%. Now the average S&P 500 return in a normal year is around 9%, I believe. And so
this is not a time to get out of the market. This is a time to buy.
Right. So historically, the market bounces back really well after a midterm election gets over and the uncertainty is relieved.
And if we just go back to where we were before the market started going down at the end of the year because of all the fear mongering by the news media, and then also because of the uncertainty of the elections, we've gotten closer to the election. If we just get back to where we were, and remember, the companies are making more money now than they were back then, by and large. If we just get back to where we were, that would be slightly over a 30% increase in the S&P 500. And I think as we get through this election, and as the truth comes out about the earnings, and then the war in Ukraine and the interest rates and the inflation are not going to be the end of the world, as that truth comes out to people, that the market will get back up to where it was relatively soon, within maybe 6 months, maybe a year.
So our second tip on how to deal is to don't obsess over daily market fluctuations. In other words, don't watch your account or the market every single day. Yeah,
because that's just about enough to drive you crazy. And it would be like, you know, it's because of our access to information that you can find out what your account's doing or what the stock market's doing every second of every business day, if you want. Well, I mean, think about it like compare it to your house, for instance. Your house value, I could ask you what your house value is, and you would give me you'd give me a number. You'd say, well, it was assessed at whatever, $250,000. Or recently a house sold in my neighborhood that's just like mine, it was 250. So I think my house is worth $250,000. No, today's market value of your house is what a willing buyer would be willing to sell it for today. Might be a good day, might be a bad day. You know, maybe the only way it could be sold is to a speculator on a fire sale price 20% less than what it really is assessed for. Or maybe somebody from California just got off a plane, is looking for a house, sees your house, that in California, a house like that would be worth, $500,000. So they offer you $300,000 for your price. What I'm trying to say is this is a long-term, your stock market investments are long-term investments, just like a house is. You wouldn't buy a house And if you were only going to stay in there for 1 year, that'd be silly. And so our investments in the stock market with retirement accounts and whatnot are long-term investments, recommend 5-year time frame or longer. And 5 years from now is going to be a whole different story than where you are right now. So no reason to worry, no reason to sell, no reason to panic. It's time to be optimistic.
All right. That brings us to our third point.
Tip number 3.
Tip.
Limit the amount and source of news you consume, both the amount and the source. Can you move our window up? Oh, go back there. So move our window up so they can see the word amount. There you go.
They can see that.
Oh, they can?
Yeah.
Okay, sorry. Anyway, got that straight. Both, remember what this is saying, both the amount and the source of news that you consume. There is a lot of propaganda going on right now through the mainstream media. A lot. It's like primarily propaganda. And if you don't already know that and don't already know that the mainstream news media is completely biased politically, I don't know what to tell you, but most people already understand that. The other thing is that they sell fear, because if they can scare you and think there's an emergency going on, like they did with COVID, like they are doing with rising interest rates and inflation and the war in Ukraine and Russia and prospects of potentially a recession, if they can scare you, they can keep you watching or listening or reading and seeing their advertisements. All they're trying, that's how they make money, is with ads. And so if they can scare people and get them to keep watching, they get to sell more advertising, and people keep paying attention. The other thing is, like I said, they're completely in the tank for the leftists around the world too. So you got to limit this. You got to watch the source of your news media. I would highly recommend people don't watch, the 3 main networks or MSNBC or CNN. And if you do watch some news on TV, Fox News is the safest. They're not perfect or anything like that, but it's less left-wing propaganda than anywhere else. The other thing is to limit the amount of news media that you consume. Back in the day when I was a little kid, my parents watched the evening news for 30 minutes at the most, maybe read the paper in the morning. That was it. Just, I try, I have to watch a lot of news in order to keep up with what's going on in the markets and the economy in my job. But I watch the source of it. I'm careful of the source of it. I only accept news media from trusted sources. I almost only read it because I can control it rather than it just accidentally coming in my ears or my eyes. And I try to limit it. If you think about it, you can get all the news that you really need in about 15 minutes, at the 15 minutes to 20 minutes every day. And you only really need to do that once. You don't need to be hearing this propaganda over and over and over, or negative news about who got murdered or whatever. There's lots of news about crime and murder in the United States right now. Well, folks, you and I know there's a hell of a lot more good people in our country than there are bad people, but the news likes to sell and tell you about the bad people.
Is there any sources of news that you read that you would recommend to people?
My primary source of news is, besides I check Yahoo Finance all the time to see what the markets are doing and see what the left-wing Yahoo Finance reporters are reporting on, but I know they're left-wing. But then my primary source that I get stuff from is called the Bongino report. It's like the Drudge report used to be, but it's just got links to different news all across different kinds of media from different sources, whether it's Fox News written article or the Epoch Times or just the news, or there's a whole bunch of them, but they're all trusted sources. and it's mostly encouraging. I'm very encouraged. I'm encouraged because of what I know about the earnings of the companies, and that the earnings of the companies are strong. That encourages me that the prices of the companies are going to go back up once the fear and uncertainty dissipates. But I'm also encouraged because of what I see with what's going on with the election, because this is a big battle, if you don't already know it already, in our country and across the world between two economic systems, capitalism and socialism, or communism. Socialism is just a nice word for communism, kind of a precursor to it. But it's a big economic battle that's going on. And I'm encouraged that there's going to be a big change in control of the House and probably also the Senate in 2.5 weeks, and that it's going to stop this rush towards socialism / communism that we've been experiencing, that's causing everybody to be so fearful. And it's the way a representative republic is supposed to work. It works well. It works right. Democracy and representative republic, which is what we have, works right when people are paying attention, when voters are paying attention, and they're paying attention like never before now. And they've had enough of this drastic expansion of government and spending money like, well, about as fast as they can print it or borrow it. And so I'm encouraged that way, and I'm encouraged about the way that the market's going to respond after the election. Hopeful, optimistic, very optimistic. But just to remember that this is the worst time to sell. Absolute worst time to sell right now is to get out of the market right now. It's actually a great time to buy.
So like we talked about earlier, just because maybe the prices of these companies are down, that doesn't mean that the underlying value and profits of the companies are actually down. So it's a great time to buy when you can buy a good, valuable portion of a company basically on sale.
That's right. We're having a sale right now.
Yeah, and that's kind of something that Warren Buffett says. And he says to be fearful when others are greedy, and be greedy when others are fearful. And people
others are fearful now, and we need to be greedy. So remember what I said about the best and worst places to have money when there's high inflation. If you have too much money in the bank, more than a few months of living expenses or something, unless you have something coming up, you're losing buying power with money in cash or CDs or checking or savings or money markets. You're losing buying power. If there's 10% inflation in the next 12 months, you just, your $100,000 that'll buy $100,000 worth of stuff today will only buy $90,000 a year from now. Or maybe if you get a % interest, it'll buy $91,000 worth of stuff. But owning the companies that produce the goods and services will protect you from inflation or income producing real estate or gold. So we want to help people and protect them from this, protect them, our clients and prospects and anybody we know or can talk to from this biggest financial threat, the threat of this hyperinflation. Another thing that some of you may think about while the market is down, if you have IRA money, traditional IRA money, this might be a great time to convert to Roth IRA. It's an individual decision and an individual. I can't just recommend everybody convert all your money to Roth IRA right now, but it has to do with your circumstances, your income needs, that sort of thing. But if you convert money to Roth, traditional IRA money to Roth IRA money right now, you pay your taxes off on everything you convert, and then all the future growth is tax-free to you and your beneficiaries. And when you reach age 72, you don't have to take required minimum distributions from that Roth IRA like you do a traditional IRA. So anyway, just something to think about. If you have a question about that, you can call me or Jesse or email us, Bob or Jesse at bobbenny.com. And right now we have a few questions. We want to try to address any questions that any of you have. So what do we got?
Okay, so let's start with the first the first one. How long do you anticipate it will take to recoup the losses we've taken this year?
You know, that's just a wild guess. It depends on, obviously, the uncertainty of the election is going to go away after the election's over. But I'm kind of hoping that I'm hoping it's going to, and expecting it to happen within maybe just a few months, 3 to 6 months. But it isn't going to take too long, because two things: the uncertainty over the election is going to be over, and this irrational fear that's been driven by the news media of telling people that interest rates are going to cause the stock market to go down or to crash, the war in Ukraine, inflation and recession. The truth about those things is going to come out. And as the truth comes out, the truth is that the companies are making money, and that it's a great place to put money, and they'll buy back in, and the market will go up. So I'm not anticipating it going to be real long, but I don't have a crystal ball either. But from my experience and the numbers, I expect it to be relatively soon. It's not going to take 5 years, I'm pretty sure. What's our next question?
Why?
I don't know the answer about that. Why is Pillin not debating? I have no idea.
Okay. Is the Kudlow show a trusted source? Do you know what that is?
That's Larry Kudlow. It's
Okay,
Kudlow.
sorry,
Larry Kudlow.
obviously I don't know.
Larry Kudlow is a great conservative. He worked for the Reagan administration. He's really smart financially, and by and large, most of the I would trust. I'm not saying I would agree with every single thing Larry Kudlow would ever say, but he's a truth teller.
Okay. Last question. Comment on the president's plan to sell the oil reserve now when the prices are high, and refill it when the prices are low.
Well, the president is not an economic genius, I'll tell you that. He's not a genius in any way. The only reason he's tapping the strategic oil reserve is to try to keep gasoline prices from going even higher than they are right now. It's purely a political reason. But he's claiming that he wants to refill it when prices are at 75. Well, who knows when they're going to be down at 75, or when he's going to get to do that. Remember when President Trump proposed tapping the oil reserves at some point, the Democrats blocked it when the oil prices were 24, when he wanted to fill it. I mean, they didn't want him to fill it, to increase it when the oil prices were 24. So it's all being done politically. It's not a good thing for him to be tapping the oil reserves to try to control the price right now, or try to reduce the price for the election, because that's all he's doing it for. But anyway, folks, have a good day. We are so glad that you attended the webinar, and hope we gave you some information that will encourage you, give you some peace. Please take our advice, or my advice, about the news media, and don't let the news media consume you and take the joy away from your life. We want to help people, and we welcome any phone calls or emails, or if you want to come in and visit about, if you're really worried about the stock market or your investments, we welcome the opportunity to help you and ease your fears. We help people in lots of ways. We help people with retirement income planning. We help people figure out when the best time to take Social Security is. We help people with their estate plans and how to avoid probate. We're experts on that. And we help people with tax strategies, tax strategies, So anyway, we just want to help you. If there's any way we can help you, if you want to contact us, please do that. And that includes any of your friends or family too, of course. Thank you
very much. Have a great Thursday.
Bye.